Welcome to Finding the Front, brought to you by the proudly West Australian company, Euroz Hartleys. This is a podcast series where we take time out to get to know the story behind the people who front some of Western Australia's leading companies. We look back at some of the moments in their life and career that shaped the journey to being the leader they are today, and provide you with some real insights into the way they think and approach things, both in business and in life. So get the volume adjusted in your car or your headphones sorted and settle in for a great story. Here is your Finding the Front host, Tim Banfield.
Hey everyone, and thanks for tuning in to Euroz Hartleys Finding the Front. If you're not familiar with Euroz Hartleys, we are a proudly Western Australian company and a leader in our field of being able to offer a broad range of financial services, including corporate finance, institutional sales, research and wealth management. Please don't hesitate to visit our website at www.eurozhartleys.com to see the services we can provide. We continue to grow our show, and in this brand new episode, we have something a little bit different and in many ways quite special. Australia has many great fund managers, but only a few have achieved the respect and success over such a long period of time as Mr. Peter Cooper, the founder of Cooper Investors based in Melbourne, who manage some $13 billion for their clients. Whilst he won't acknowledge it himself and shies away from this type of recognition, Peter has been referred to as an investment legend and a titan of Australian funds management. An opportunity to sit down with Peter for an extensive conversation and gain such deep insights is rare. Peter covers off on his background and what led him to his love of investment, the influence of the great Warren Buffett and Charlie Munger, long-term investing, and the Cooper Investors philosophy, and the present state of the world, including his observations on the rising interest rate and rising inflationary environment, the Russia-Ukraine conflict, India, China, Bitcoin, oil, gold, governments, the Australian dollar, decarbonisation, and his views on active versus passive investing. As they say, knowledge is no burden to carry. And this is a podcast where Peter shares his valuable perspective and one that can give some serious understanding of life as a highly regarded, long-established manager and investor of money. So without further ado, it gives me enormous pleasure to introduce to the Euroz Hartleys Finding the Front, Mr. Peter Cooper. Peter, welcome to Finding the Front, and it really is such a treat to have you in Perth face-to-face after the hiatus we've had here in Western Australia with our lockdown, and the fact that you could actually fit us into your schedule on the few days you are in Perth is just so fantastic. So thank you very, very much for your time.
Pleasure to be here, Tim, and it's good to be out and about around the traps. Well, you know, it's been, I think, nearly 3 years since I've been to Perth, and I love it here.
Yeah, look, it's just so excellent. So look, just for our listeners' sake, before we kick off, I just wanted to put a brief framework around your career for our listeners. It's a celebrated career. It is very well documented, but I just want to put it into context with regards to our conversation and your journey. So for the listeners, Peter has been described as an investment legend. Now, I read this in an article recently, and he is seen as a very highly regarded and admired member of the Australian funds management industry that is committed to long-term investing. And he's not one that seeks the spotlight. So we are very privileged to have him on the podcast with us. He has over 30 years of investment management experience, which commenced when he joined the New South Wales State Superannuation Investment and Management Corporation. He was there as a specialist industry analyst and progressed to deputy portfolio manager of a $7 billion portfolio. In 1993, Peter ran the Australian stock portfolios for BNP and then joined Merrill Lynch Investment Managers, where he worked for 7 years, culminating in his position as head of Australian equities and managing director. Again, where he oversaw a team managing $7.5 billion in Australian equities. It progresses from there. He founded Cooper Investors as a specialist equities fund manager 21 years ago in 2001. The amount of funds under management has grown over this time to approximately $13 billion. They invest on behalf of some 4 million Australian individuals and families from all walks of life and all manner of employment and industry. Their clients include large pension and superannuation funds, religious institutions, Australian state government agencies, school endowments, charities, high net worth families and retail clients. Cooper Investors currently runs some 7 funds, with the flagship fund being the Brunswick Fund, of which Peter is the portfolio manager. He's been running this for nearly 18 years, achieving an annualised return before fees and expenses of around 16% since inception. That is quite something. We know past performance is no guarantee of future performance, as they say, but that is quite a fantastic track record, Peter.
Thank you, Tim. Just one small correction. I'm the joint portfolio manager of the Brunswick Fund along with Justin O'Brien, who's been with us for roughly 5 years.
Right, okay.
Yep.
That's good to know. So it's great to have you on the show, but the important part of Finding the Front, as that background illustrates, is to provide our listeners with some insights into your background and what led and shaped you into being the real leader you are today in the field of investment management. And I just thought we'd start. You grew up in Melbourne, but there's a bit more to that before Melbourne arrived.
In terms of my journey, Tim, I was actually born in Brunswick, Melbourne, but my family moved. My dad was a jail guard at Pentridge Jail, and he came here as an immigrant from New Zealand, was in quite a successful family business, but ultimately sort of went through that normal life cycle of family businesses, and so he came to Australia without anything. His first job was a jail guard at Pentridge, but he took the family up to the Northern Territory, and in my my sort of formative junior years, we lived in a hotel in Pine Creek, which is about 2 hours south of Darwin. It was a little 150-person town in the outback, supported by an iron ore mine called Francis Creek back in the boom days of the
Wow.
late 60s. Yeah, so had some, I guess, exposure to resource cycles, agricultural cycles, outback Australia. So it was very formative times growing up in a hotel in Pine Creek.
Coming back to Brunswick, tell us a little bit about Brunswick. What was it like?
Well, I left when I was 2 or 3 years of age.
Yeah, okay, yep.
But back I was born in 1959, and in the 60s, it was very much a post-World War II immigrant suburb, Italians, Greeks. Today, it's been gentrified somewhat, but it has a whole new wave of immigrants, namely from Asia and Middle East, if you like, in terms of that wave. But it's a very interesting suburb from that dynamic, just very entrepreneurial, very creative, hardworking, working-class suburb, certainly back in those days. And I always have to laugh. My father sort of likes to talk about his experience in Pentridge Jail, and Ronald Ryan, if you remember, was the last man hung, and so he shot a fellow called George Hodson, who was a family friend, and so my dad sort of talked quite a lot about that during his time there.
Wow.
And one of the funny lines he likes to use is that there's very little difference between the jail guards and the prisoners in Pentridge back in those days. The demographic and generally the wives of the prisoners lived in the suburbs and so forth. So it was quite an interesting social exposure, if you like.
Yeah. Well, clearly, I mean, you do reflect back on your time at Brunswick, because that's what you called the fund when you started.
Yeah, look, we were sitting around sort of twiddling our thumbs thinking about names and couldn't really come up with a name. So, I latched onto the word Brunswick, but it's really stuck. It's what we actually see in companies with founder and family linked companies. There's sort of the professional aspect of investing, which we're very diligent at executing on, but there's an emotional investment, for me at least, in this fund, given the background and I guess the durability is something that really is front of mind for CI and the CI way. We can talk a bit about some of the attributes behind that. But yeah, like growing up in those sort of environments, my dad went on to be a kind of prolific small business owner, some successful, some not so successful, but really went on the full roller coaster ride of the 60s, 70s and 80s. And we can talk about sort of economic cycles, very different than today's environment, up until recently of, sort of high interest rates, liquidity squeezes, bank controls, really made it tough on business and family life, if you like, in small businesses. So yeah, I guess have had a long exposure to those type of conditions, which really do shape one's psychology.
Yes.
I'm happy to talk about that in terms of the investment philosophy and risk and latency.
So, one of the things I drew out of my research around your past was that you really did grasp that hardworking style of life that your family had. Through that small business style of life, I suppose you were able to see firsthand they were working flat out.
Yeah, well, as people in small business can attest, our family life was 2 working parents, and these are 7-day-a-week businesses generally in the hospitality and food industries. And my dad also had a contract cleaning business doing Air Force bases up in Toowoomba and university. So that was out of hours, still 7 days a week. And so, yeah, I guess I'd it's not like a university education. You just live in that as an experience, and you see that, and you get out of bed early. And, if you don't get out of bed, the business doesn't go forward. So it's just that kind of attitude towards hard work. I think there are some limitations around hard work and working smart and so forth. But, I think I'm just such a big admirer, and I've had a bit of exposure to studying when I was working at the University of New England. There was this kind of research unit there into small business and industry associations, and we used to do a lot of, analysis on small businesses. And I've got such a lot of admiration from my own upbringing, but also analysing these businesses, the employment that they provide,
Yes.
the underbelly of the Australian economy, and in many respects, they're kind of politically quite a weak group, it would seem to me. So, and quite a disadvantage when we look at the regulations and the barriers and competition. COVID, you walk along Chapel Street in South Yarra there, and, it's just devastating seeing small businesses really feel the brunt of a lot of the, the COVID lockdowns and, the pandemic consequences. So, I've got a lot of empathy towards that sort of sector and community. I think a lot of the innovation now that we're seeing in, more technology sensitive service, advanced manufacturing sort of industries, very much come out of individual founders and, ultimately small business.
Fascinating. It's very sad the impact COVID had on, like you're saying, with Chapel Street and those small businesses. How is it recovering now?
I went to the US a month ago to get married in Hawaii, and when I came back, and this was last week, the streets of Melbourne were bustling. It was actually
fantastic.
Really interesting. There's a real step change in terms of people coming back. The Fridays, as I say, Thursdays become the new Fridays. That seems to still be operating, but there was a real energy in the in the Collins Street food court where I get my lunch.
Oh, good. Geez, it's great to hear. You ended up, just talk to us a little bit about your schooling. So you went to a few schools, but you ended up at the Gold Coast?
So primary formation happened in the Northern Territory. Then the family moved to the Gold Coast, went to a Bog Catholic school called Aquinas College.
Yes.
Look, it's not to be recommended, really. It was a pretty basic education, and I was very proud. And one of the most joyful days of my life was to be able to afford to send my kids to private schools in Melbourne. So, but the upbringing at Aquinas College was kind of interesting in a formative way. It was, like to say, the school had a very sort of gambling and alcohol celebration was quite a big part of it. You go to school fete, and parents would be down the back playing two up, and my dad was quite big into races. So as kids, we used to go along every Saturday to the Gold Coast races, and half my teachers were pencilers.
Right.
Moonlighting and so forth. So, it had a, very sort of, middle class Australian existence. It's something, I guess, when I look back, it was quite a sheltered education. Growing up on the Gold Coast, it was basically, rugby league and surfing on the weekends. And it was a simple life.
Peter, I noted what had an influence on you was the racetrack. You used to go along there a little bit with your folks during those times. Can you just give us a bit of an insight into that?
Just leaving aside the ills and evils of gambling, which I'm not a fan of, what I guess betting and, sort of progressed towards what you'd call professional approach to investing on the racetrack. And it started out and went into my early 20s as well. When I was at university, had a group of friends. We'd go to, country racetracks where information was very disparate and hard to find. But, when you found it, it was, really interesting to see how that played out on racetracks. And so putting a valuation around risk, sources of information became, you're talking about trainers, strappers, informed people at racetracks. It's just really fascinated me from a kind of a risk approach.
Yes.
And you see anomalies in betting markets, and it's become incredibly sophisticated now, and it's AI and data analytics in that space, but this predated all of that. So, that sort of really, got me interested in what you'd call factor analysis, looking at different influences upon outcomes, which I've taken into my, company investing career, and long ago gave up the racetrack life. I have a funny story though. Toowoomba races, Clifford Park's a very strong racing community.
Yes.
One of my mates was the camera guy there, and it was in the old days of the old, I think 35 mil cameras. And so he gave me a bit of a lesson on how to do this. He was on holidays, and so you climb up a tower, and I'm sort of 3 levels up, and the horses are coming down the straight. It was a very close race, and it was a triple dead heat, three-way finish, right?
Right.
And trust me, the midweek races, it's a pretty hardcore community down there. And so I've hit the camera button, 20 metres from the line. The film goes. You then turn off all the lights, pull the film out, and you've got 3 buckets of chemicals. And so being a bit inexperienced, I put the film in the wrong chemical, the finishing chemical bucket, which completely destroyed the film. You then roll it up, you shoot it down a little pipe to the judges down below. They're yelling out, I probably can't say on the call what they said to me, Tim. And then the judges have to make a decision because there's no film. The judges also put up the film down where all the punters are. I kid you not, the punters were shaking the tower. I couldn't come down for about an hour afterwards. So look, that I had some great times in that community, and that was all through university. And one reason I didn't do so well in the first 3 years. And like to say, I did a 4-year economics degree that took most people 3 years, so I was a little bit distracted.
But on that, Peter, that's a fascinating story, and thanks for sharing. When you say you went on to do an economics degree, one of the things that we often talk about on the podcast is how did you know what you wanted to do at the time? Did you have any inkling into economics and finance or that sort of thing, investing? Outside of the racetrack?
I can honestly say, so I was 17 going on 18 when I went up to Toowoomba, University of Southern Queensland, because my parents moved there. I had this contract cleaning business up there. So that's why I kind of ended up going there.
Yeah.
But, growing up on the Gold Coast, I had no idea about investment banks. I couldn't tell you what an investment bank is. I didn't know much about institutional investing. My dad used to buy and sell mining stocks, which kind of got me interested in. He was a bit of a small-time real estate investor and, booms and busts in that. So I had a very innate, interest in investing.
Yes.
Which was probably initially expressed on and at the racetrack. And then when I moved to Sydney, I took a couple of courses in finance and so forth, which I did quite well at. I was sort of interested in that. I remember taking a course in futures, but I had no idea of kind of relating that academia to actual, organisations in Sydney or Melbourne. And,
yes.
You could say quite a sheltered understanding of the world. And it's, when I compare young kids today, they just seem so advanced relative to what I was. When I moved from my job at the University of New England to Sydney, I had basically a choice of jobs. One was about OTC, the Overseas Telecommunication Company, and the other one was State Superboard, New South Wales. I've still got the ad, actually, that I looked at as a 3-line ad in the public service sector of the Sydney Morning Herald, and it was for $17,500 a year. And then for 6 years, I'd go up about $500 a year.
Right.
And I had a few mates, into that 6 years who were in investment banking. And, when that gap got so wide, I thought, geez, I might have to leave here.
I might have to look around a little bit. Yeah.
But long story short, I made a choice between the sort of business analyst at OTC and investment management or assistant analyst at, the State Superboard, New South Wales. And
Yes.
It was the innate, interest in investing. The other job was paying $27,000. I took the $17,000 job for the reason that I was interested in. It's a good advertisement, I think, for just don't worry about the money, just follow the passion.
Yes.
You hear that a lot, but I completely agree with that idea because you can't sustain your career and interest without that interest, would be my view. So I was always very kind of interested through that avenue. And once I got in the State Superboard, I sort of, talked about brokers and, investment banks.
A whole world opened up.
Found Warren Buffett's newsletters. And so I just went on a, 6-year, self-learning exploration around investing. And it was just amazing to me. And it's, I look back once again, talk about mentorship with people. I never really had mentors to, kind of fast track through things. I sort of tended to be, I like to say, Tim, I know this is sort of a personal story here. I consider myself a slow learner. So if you look at my career, I tended to do things very late in my career. I didn't have a real job until I was 26, 27. I was the ultimate, or the original millennial, let's say. I sort of bobbed around, did a few jobs here and there, went overseas for a couple of years and, I just sort of
had a good time.
Yeah, my motivation, I was always a hard worker, but my motivation was if I wasn't happy, I moved on. So, this sort of journey through the investment field, I think it's so exciting for kids and younger people. My kids and their friends are, so inquisitive. Some of them inquisitive about, a lot about crypto and, different ways of investing. The access to information now is just incredible.
Yes.
And, multiple sources, podcasts and YouTubes. When I was on my journey of exploration, was pretty limited. Annual reports were, you never got revenue lines. In 1987, you'd get annual reports. There'd be nothing in the annual report.
Yes.
It's very low disclosures. So, that information and ability for people to kind of really self-educate now is amazing.
Based on that, how And he was such a big influence on you, the Warren Buffett, Charlie Munger, John Templeton, Peter Lynch, that sort of thing. How did you come across these guys?
I think this idea of cumulative knowledge. So the short answer is through books, and going into State Super there, talking to different people. I can't remember exactly the time, but just started, I guess, going from one to the other. But my introduction to Peter Lynch was just through the books that he wrote.
Yes,
I used to go down to in Sydney there. The Stock Exchange had a bookshop, and there was Buffett and Lynch books back in those days. But singly, the most important influence upon my investing career have been books.
yes.
and quality newsletters, singly, like by such a long margin. It's not funny. And it just astounds me. Thank you for the introduction, by the way. It was very humbling to hear those nice words. But seriously, some of the amazing investors, and you can't go past Munger and Buffett in many respects. We'll come back to that point in a minute. But their ability to share and their communication skills are just incredible. And I don't consider I'm in that category. But the ability to actually leverage the information, the way they've gone about explaining them, and not just them. There's lots of people that have done that. I find that just so generous of spirit.
Yes.
And sort of passing on that wisdom and knowledge. Just on Buffett, I had in 19 and in care of State Super Board, I had an opportunity to go around, looking at companies and other fund managers in the US. State Super had sort of external managers and so forth back in those days. So that was a really fabulous experience, and some of my other employers, just wonderful exposure and education. But in the early 90s, I wrote to Charlie Munger, not Buffett. I thought I'll try Chaka for a job. So I wrote to him. Didn't get a response, which was a bit disappointing. But so I rang him up in Los Angeles and got through to his secretary or EA back then. And she said, we'll get back to you. The message I got back, well, there's no job, but he's happy to have breakfast with you at the Californian Club in LA. I said, I'll do
fantastic,
that.
Yeah.
So I had an hour and a half with Charlie just after they bought that big piece of Wells Fargo in the early 1990s. And it was just an amazing experience for a young fella to sit in front of such an incredible. I did the calc on I think he's 98. He was 62 at the time.
Wow.
He seemed really old. Well, I remember when the differential in age.
Yeah.
And so one of the wisdom point, and so getting exposure to some of these people, for me, it's just been gold.
But what an opportunity!
Yeah, no, it was truly amazing. He said one thing that I really recall from the conversation I'd like to share, and it was I was sort of sitting there thinking, I was a bit nervous, and like we're chatting away, and I'm thinking, we're kind of comrades here, we're in the same business, great
brothers
investor,
in arms.
and he said to me. What he asked me what I'd do, and I explained that to him, and he said, well, we're in completely different businesses, Peter. I thought, I wonder what he meant by that. And what he meant was that, as he explained, that, he doesn't have anyone to answer to. It's a closed-end fund, Berkshire Hathaway, and I'm in a public, I'm a public servant with stakeholders everywhere and, money that can go, so to speak. So, it was the first time I really kind of thought about that proprietorial attribution that we talk about in our investment style.
Yes.
It's very, very real. I went through a period, Buffett and Munger have become like rock stars on steroids, right? And so, for the last 10 years, I sort of keep an eye on what they say and stuff, but I haven't really been that interested in what they've been doing. I've been looking at other things. But I decided to, because one of the internal guys circulated it last week, the AGM. So on the weekend, I actually sat through the 6-hour Q&A session of Buffett and Munger. Buffett's, 90 and 98 for Munger. And
it's unbelievable.
Those guys, I recommend it to your listeners.
Yes.
The investment of the 6 hours is absolutely gold, and I'm so glad I did it. They're sort of saying and espousing the same things, but they're so incredible because they've been able to adapt their philosophies and principles to contemporary problems, inflation, crypto, they've got a view on everything, and they're very generous with their opinions. So it's just a truly, truly magnificent experience to actually see two investors of that age still passionate, still hungry, it would seem, and, dedicated to their cause.
It's amazing how they've mastered the art of keeping things simple.
Yeah.
It seems to be a very powerful tool they use.
Yeah, I agree, and I've never been able to achieve that level of purity that they have, and it's because of the environment. And so my expression of what you've just said then is basically integrity.
Yes.
And if you define integrity, the alignment, the key word's the alignment between kind of goals, philosophies and actions, that they're just so pure around that. You know, they think of things and then they do them. They're not beholden to, I guess, other stakeholders in the way that, you know, many other people are. And Buffett talks a little bit about his choices. You know, he worked with other people and
Yes.
he explicitly talks about that choice and career path that he chose because he didn't want to be, you know, I guess, beholden to other people's opinions or directions.
So that meeting with Charlie, did that have a real impact on you in terms of, was that almost when the penny dropped to say, right, well, I know you went on to Merrill Lynch from there and BNP and Merrill Lynch, but is that when you started to get inklings about this proprietorship and where you ultimately wanted to end up?
It was a bit like the slow learner point that,
Yeah,
that I was
right.
trying to make before.
Yeah.
Absolutely. And I kind of, you know, having come from a small business background, you know, I had been thinking about, well, what would a startup investment management firm look like? And I worked with David Paradise, who you may
Yes,
know, back
yes.
in State Super days. So Dave's gone on to bigger and better things, and he and I partnered up for a few years. So, you know, we had a lot of conversations around what would that look like and what sort of partners would you know, want to go into business with. There were many opportunities. Interesting, and one of the reasons it took till 2001 to start up Cooper Investors was, you know, the sort of partnerships and the fear of risk, if you like. You know, school fees, mortgages, all those sort of things
Yes.
kind of deferred, and experience. You know, like I think everyone has different levels of, I guess, confidence around their abilities and experiences. And one thing I remember talking a lot about this with David was our kind of obsession around independence. And so a lot of opportunities to jump out as, you know, part of a bigger organisation and own 50% of it, or partnering up with distribution companies that, you know, take out the fundraising
Yes,
risk.
side of it.
We decided no to those many opportunities, not around economic reasons, but just this idea of independence. And so, you know, in 2001, sort of had enough, I guess, capital behind me to sort of prepay all the school fees and get on with it and take that
And have
risk.
a- have a go. Yep.
that sort of idea of capital, you know, in a proprietorial structure. In the case of Berkshire, that's a listed company. In CI, it's a company, private company, so has a lot of, I guess, levers for self-determination, which is a big focus around the strategy of the company.
Yes.
I like to say under any circumstances, you know, going back through 120 years of financial history, I think Cooper Investors has a innate conservatism built into the organisation around, you know, people and finance and client expectations, etc. And, you know, the way we run the business is markets go up and down, and we want to be here, you know, during the dark days as well as the good times. And, you know, the good thing about those dark days is that's when opportunities are at their greatest. And so we really think about that through the cycle mentality.
That's really interesting. You did spend a fair bit of time with BNP and Merrill Lynch in what are international institutions. How did that formulate? It's almost the reverse of the proprietorship model.
Yep.
And you're reporting through to international colleagues from Australia. How did you find that? And did that shape you as well?
Oh, look, the experiences with these bigger organisations was just irreplaceable. And I'm so lucky, I feel, because, you know, I went from the public sector into Bank National to Paris, and it was kind of I was there for about 3 months. I think, oh my God, what have I done here? You know,
Yeah.
I've got into it. At the time, BNP was a government-owned entity,
Right.
French government-owned.
Yes.
It was a bank, and it was French. And in terms of
Did you have to speak French?
interestingly, they had French classes, and I was a bit, you know, got a bit focused on the stock picking, but I didn't attend too many of those. But they had incredible culture. The chairman was somebody from Paris, and the chairman, while I was there, didn't actually speak English. And so, you know, they had incredible French wines at lunch. They had really unusual culture, but it was very bureaucratic.
Right.
And, you know, they'd fly me around business class, and I said, I don't want to do business class. I just want a library, you know, I want to buy a few books. And I had to write requisitions back to Paris, and it was just a really, highly bureaucratic organisation, but they had a lot of quirky investors, and particularly gold investors, interestingly, you know, sitting in back offices in Paris. So once you got into the organisation, and BNP also are the oldest foreign bank in Australia. They came to Australia in 1860, I think it was, as financiers to the, you know, the wool and agricultural trade. So it's a very, you know, rich legacy organisation, and their banking clients are actually quite significant so that was a kind of an exposure that I hadn't had before. They also own 30% of a company called Neuberger and Burnham, which is Roy Neuberger was the New York broking firm that flipped themselves into asset management.
Right.
And so I had the opportunity to visit them. And Roy Neuberger back then was kind of 94, 95, still coming into the office, deeply proprietorial, even though I think BNP owned 30% of them. So getting those sort of exposures, and I love to tell my colleagues that Roy wrote a book when he was 96, I think it was, and the title of the book was So Far, So Good. So, and he passed away at 110
what an
a
innings.
few years ago. So I'd like to tell everyone around work that I've got long genes in my family tree. But out of BNP, came down to Potter Warburg Asset Management, which was half owned by Mercury Asset Management, which is a big UK fund manager, and Mercury was a subsidiary of UBS. So the culture in Mercury was fantastic, had a very proprietorial feel to it. It was in the early days, very investor-centric. Then they kind of brought in the McKinsey's team and turned it into a professional business and ultimately became an asset gathering shop. But the exposure to and I like to say I've had the French, the English and the American experience here, and they're quite different cultures.
Yes.
The culture in Mercury was just outstanding. They kind of have a real meritocracy approach. They had what they call a red brick university policy, really employing smart people out of non-kind of Oxford and Cambridge types, although there's quite a few of those in there as well. But they, the Barrow Boy concept,
yes.
And that really appealed to me because I sort of fancied I went to those sort of second-rate universities as well. So, that commitment to professionalism and really nitty-gritty approach was, very influential. And they're very, very good on the business side. But probably the best exposure I had in terms of managing a professional services side, measure twice, cut once,
yes.
Really strong rules of engagement around risk, compliance, all that stuff that people don't talk about in investment management.
It's so important.
So important.
Yes.
And, I saw some pretty wild things in my career in terms of, people doing not illegal, but just not sort of professional,
yes.
let's call it. Mercury were the ultimate in crossing T's and dotting I's. And so it was just really fantastic. And I really owe a guy called Maurice O'Shaughnessy, who was the CEO of Mercury at the time, when he kind of tapped me on the shoulder to take over the Aussie equities. I was given retail fund, which was going out the back door at the time at Potter Warburg's. And, they flew in a McKinsey's team from Europe to assess, when they took the 100% of Potter Warburg's, to assess what they had there. And, there's a lot of fear around closures and sackings and so forth. And, everyone was very nervous. And, they just methodically went through the business, the funds, the PMs, the managers, etc. And, I was kind of lucky enough to get through the focusing that they did with the help of McKinsey's, and Maurice O'Shaughnessy was the guy that, I really owe a lot to in terms of giving me a bit of a break
An
in terms
opportunity.
of,
Yep.
run this the retail part of the Potter Warburg business, which ultimately I sort of took over the whole Aussie equities side of things. And then we went to the Roaring Bull when Merrill Lynch took over Mercury. So I sort of had three jobs with
yes.
three different business cards, but the same job, but completely different cultural experiences. The Roaring Bull, Merrill Lynch was interesting, and I think the Roaring Bull is the right sort of descriptor of the culture there, because it was and not bad for me, because the English culture could be summarised as measure twice, cut once, iron fist, velvet gloves. So, they're very
yes.
pleasant and very articulate in their deliberations and communications with employees. And then the chopper would come down. Very clinical decision makers, but very considered.
Yes.
Merrill's were kind of different in the sense that, I'll never forget a conversation. I won't say the name of the guy, but he was the Wall Street guys in charge of Asia Pacific asset management business, and came out and we had dinner, the usual dinner with the big chief. He comes out, and there's a few of us around the table, and comes to me, Peter, so what's your ambition? And I said to him, I hadn't thought about that. And, I'd just like to continue performing for the clients. And the money was, the fund that I was running, had been very successful, and it blew up, and then I took it over, and it had 3 years of outflows. It was down at $150 million, right? Just unprofitable. Anyway,
the writing looked like it might have been on the wall.
It was a bit of a nervous time. And so, we got the performance going, and, for 3 years, and the money was still dripping out. And then on the third year, it, started to trickle in. And as you know, in the retail business, that trickle turned into a couple $100 million a month, and it's just flying along. And I'm thinking, Jesus, how do we actually invest this money coming through the door? And, this guy's sort of asking me what's my ambitions and so forth. So I just said, look, I'm, really keen to keep the performance going, look after the clients. And he said to me, quote unquote, never forget this, boy, you just need to lift the bar a bit. And at that point I thought, I had a few other exchanges with him, just incredibly aggressive culture compared to the English was, assertive but not disrespectful, if you like. So he just had a very caustic, toxic feel about him. So, but what was good about that for me, I think, and this is a general description of Wall Street in a way, it's just very ambitious. And if they believed in you, they just backed the truck up. And so their strategy, I used to like to call it a crash or crash through.
Right.
And so you didn't kind of die wondering, whereas maybe the English, they let the string out slowly. And so I feel I've had exposure to both. And there's, as the Buddhists like to say, there's the middle way. And that's, I'm Virgo, Tim, so I like to be balanced about things.
Yes.
And I think there's a bit in that, having that, I think you need to be assertive, and I think you need confidence in business for sure, and investing, but you can have too much of it and you can have too little of it. So I think the game is really to calibrate and, have a kind of equanimity about, how to approach business and clients and in the topic of investing. So really that exposure across those two formats really set me up, in all sorts of ways, not just as an investor. I remember thinking on the technology side, like I had 50 people I could tap into, but they were in London and Princeton, and then you got in a queue and the bureaucracy. So we've built a business where, everyone sits within sort of 20 metres of where I sit, and, we try to keep it tight and very direct and very focused in on our needs. And look, bureaucracy, I've got to admit, some days I wake up and think, geez, are we back at bureaucracy land again? So, constant work at simplifying processes and businesses, never forgetting the reason that we're in business. The name Cooper Investors, I like to talk about the word investors. It's not asset management or investment management. And there's a guy called John Cloney, he's the CEO of QBE. I used to go and see John and got quite a good relationship with him. He said, Peter, how come you guys always call yourself asset managers?
Yes.
And back then, QBE was a big direct investor. They were in all sorts of, big resource investors, and they were quite somewhat curial and turned out to be a little bit cavalier in the end. But they're a really closed-end investment shop back then, and had a real passion for the investment topic. So that sort of idea of us being an investor shop is just so important. And so I just never you can quickly lose sight of, well, why are we here?
Yes.
Well, it's just to invest. That's it. Not about asset gathering or all the other things that you get involved in. Now, risk is a huge part of investing. So, we spend a lot of time on that. But, in risk cultures, I would argue, you need both process and you need qualitative genetic disposition to understanding and sniffing out where the risks are ex ante, not just relying upon, process box ticking and external consultants and so forth that so many companies seem to get tied up in.
Yes. And I'm glad you expanded on why it was called Cooper Investors versus Cooper Asset Management or the like. It's because it does really put into perspective the sort of business that you're building or you've built. I say building because I know Cooper Investors is ongoing. As I say, it's got longevity. From a business sense though, and many of our listeners are business owners, what were the things that were important to you when striking that business? You had the benefit of these international firms from different regions. You had the benefit of the New South Wales State Super in hindsight. And then you had all that accumulated understanding of small business and watching your parents work and grow. What was important to you when setting up CI or Cooper Investors, ownership, alignment, fee structure? And I think importantly, when you look at it now, Peter, in this world we live in today, how have you been able to manage to attract and maintain quality staff that are high performing?
A couple of things were really, really important. Self-determination, number one, just having that sort of self-agency to determine one's future path. I love the conversation with Charlie Munger. That's been very, very, very strong. I think, the ownership, there's different ways to do that. Ownership structure, company strategy of not having outside sort of equity owners. Never say never, but the experiences I had, so strongly burnt into my brain as to why I left Merrill's, those midnight phone calls to Princeton and London. I just don't want to do that. I'll never forget in the tech rec, we were going super well in Australia. You get the phone call, it's, 30th of June bonus time, and it's look, Peter, we've got to share the pain. This is the global network. New York blowing up, and the bonus pools out the window, and so we'd done really well, and they were kind of cutting the bonus pool. And then the second call that came in was drop the famous Jack Welch drop the bottom 10% line. And I'd never actually heard of that line. So, what do you mean drop the bottom 10%? Head count, boy.
Drop it.
And, that's just ridiculous in an investment management business, because it's a farming, you want to plant the seeds in the, when the opportunity's there, and that's when they're there in the downturns. You want to invest, right? You want to be contrarian almost. And at CI we are, we hire people in downturns, keep on investing through the cycle is a very strong business principle that we have. And so that independence and self-determination, is very, very strong. And that allows you two things. One, it allows you to creatively sort of explore what you want to do and apply your skills in a way that you want to do it. And Brunswick Fund came out of that. Brunswick Fund is effectively, it's benchmarked against the ASX 200 because that's where 75% of the capital's invested. But it's really a very unbenchmarked, non-index type of fund that was set up to kind of invest money the way that families and myself wanted to invest my family money. That was the original kind of idea of it. But I didn't want it to be a hedge fund. I didn't want to do fancy structures and so forth. So it's pretty basic structure we have there.
Yes.
We'll talk about it a bit later on. But, it's simple, long duration. We didn't have any need to grow the fund. We've kind of slowly invested and grown it. But, there's no kind of, big strategy for asset gathering and so forth. So unlike the conversation with the fellow from Wall Street about, ambitions and growing the revenue streams.
Yes.
It's about getting investment returns. So that was very, very clear in my mind. And that's why, having sort of outsiders as equity owners or being part of a distribution network is not that interesting to me.
Yes.
Because it compromises that sort of reason. On the people, you want to work with people that you like. We're we're performance driven. There's people that have come and gone at CI of, really, really one of the things that I feel very good about is that I've remained professional friends and have very close relationships with many of the ex-employees of CI. Some of them have gone on to bigger and better things. And I've invested in their funds. And so, I really like that sort of a collaborative, slightly non-competitive approach in many respects, because I just don't see other people being the competition at all. The only competition that we have is our own abilities and our minds and our disciplines to be able to stick to the philosophy of what we've got.
Yes.
That's the competition in my mind. And so being able to work with people that I really enjoy working with and share, and there's lots of different personalities at CI. I really enjoy watching some of the thing that gives me most joy now is, seeing the kind of next gen, the 30 to 45-year-olds coming through now. And, we've got some fantastic talent. Retention, is a really big issue, but I think that the culture of the organisation has been, we pay well. We don't have any leakage outside of the organisation, so we've got a lot of capacity to, reward. We really try to align people to their success.
Yes.
Money is very important to people, of course, and particularly in the investment game. But I think culture is equally important because, you work long hours in this business, and people want to be with other like-minded people that they get along with, explore opportunities together. That creates a lot of joy and fun.
Culture seems to come through most of the things I read with regards to Cooper Investors. I mean, whether it's on the analysis of a company, hubris, humility, we can get to that in a minute. But the things that you picked up early, like the propensity to read, the reading of books. I mean, there's so much available information online now. Is that a real theme within Cooper Investors? Is reading still as important as you found it when you were doing your time?
I think so. Some of these young guns are just incredible. They just leave me in the dust. And we've got we've got sort of 5 different values, and curiosity is one of them. It's not a top-down thing, Tim. It's kind of an osmosis culture in many respects, and so people find their levels. They find their kind of areas of passions and interest. But I would say it's very strong, the kind of appetite for learning and self-learning inside of CI, and it's driven by curiosity.
Yes.
And, and opportunity, I guess, like this sort of idea we've got like to say the single purpose. When we get out of bed, what do we think about? It's what we call risk-adjusted value latency. And the word latency, is code for value, but risk-adjusted value.
Yes.
And sort of, finding in the public markets organisations, that sort of share that passion. And when you've pushed that, from investment into the operational, founders and innovators and so forth, there's just a poultice of people out there who are growing value and thinking about value in all sorts of different ways. Some are innovators and growth orientated, others are kind of vulture value acquirers, if you like. And so we love the idea, and this originally came from Peter Lynch's One Up on Wall Street book, where he talked about these different subsets of value. So we've adapted and evolved that concept, and I really love that idea of getting access into opportunity, but through multiple lenses is something that we're very keen on. And then inside of CI, there's kind of people with different expertises
Yes.
around those. Some are a little bit more thirsty and hungry about the low-risk turnarounds and the asset plays and the cyclicals. Others are, more interested in that sort of quality founder-type company. So, there's some really good individual expertises inside of CI. We've got this kind of emergent opportunity in the endowment-style equity investing. And, so we've got some guys, Ryan Reidler and Chris Dixon in there that are just, really red hot on looking at uncorrelated sectors, clusters, stocks, and building through portfolio construction. So, building that expertise. We kind of kicked that off. One of the founding directors, Steve Thompson, his original idea.
Yes.
And, we've been wandering around some of the endowments in the US and, really studying what they do at kind of guys like Dave Swenson at Yale, was the father of endowment investing. We've sort of adapted some of their concepts, which are more, multi-asset class investors, but we've applied that thinking to public equities, and it just gets richer and richer in terms of opportunity to kind of blend securities together in endowment style investing. So there's all those type of innovations, and I think this new, we'll get to talking about stock markets in a minute, I guess, but it's been a 30-year kind of era in a way of falling interest rates, lower inflation, and financialisation of everything. I suspect we're entering a new era, and we think endowment investing is actually going to be one of the real covers, almost taking the clock back 50 years, isn't it? So exploiting that, with our internal skill sets, something that's really exciting.
I think when we look at Cooper Investors and the way you've built your business, two things come out, the two pillars of money management. And I just want our listeners to understand your view on money management. And then we can go into what's going on in the world at the moment. Could you just explain that? And I think embracing the ideas of hubris to humility, observations and predictions, patterns, just things like that probably explain to the finding the front listeners on what you're looking for, what you're looking to achieve, and how you go about achieving it. Because I think it's really important.
So in investment management, kind of a triangle, I guess, between, the culture, which informs behavior and the way you approach problem solving, the way you approach opportunity, the way you handle risk events and so forth. So that's one cornerstone to the way we think about it. And I'll come back to explaining what are the key drivers behind that. Then there is, how do you buy and sell stocks, and what are you actually looking for? And so that's an investment philosophy we've got. And underneath that investment philosophy is VOF. So, if I give you the 1, 2, 3 of VOF, it's simply we look for one thing, and it's risk adjusted. And the risk adjusted bit is value latency. People just talk about, so we're looking for value, but it's got to be risk adjusted. There's two ways we go about looking and seeking for, those opportunities, and it's qualitative and quantitative. And the secret sauce at CI is the qualitative.
Right.
Okay, so I think we've built standardised formats around how to value companies, how to think about management. We have very detailed checklists around, what are we actually looking for behind management, industries, operating business models, and how to actually value a company. But a lot of that is, you can read in valuation books, you can read it in Michael Porter's strategy books. There's nothing particularly unique. I think the way we've standardised it and integrated those informations is very, very important. And whilst I wouldn't say it's a massive competitive advantage because lots of people can standardise and integrate, the actual discipline to do that, I think, has driven a lot of value at CI. And then, the actual decision-making process, the portfolio construction, how we do that is very much driven by these subsets of value. So getting diversity and looking for value in different places, not just growth companies. We've got stalwarts, we've got these reversionary opportunities, which I particularly like myself in terms of, low risk turnaround stocks. Investing in QBE after September 11, for example, is a good example of that. Investing in government entities, Commonwealth Bank going way back in time, or Horizon more recently. Governments getting rid of businesses. It's a great area of opportunity. Spin-off divisions of companies we've made an art form out of. They're what I would call low-risk turnarounds. So the value is coming from just optimising, what is a good business that's lost its way. That's different than, I guess, strategizing and winning market share and growing into new territories that are common with growth companies. And then we've got these kind of, asset plays and endowment-styled income stocks with long duration. And, we've added recently describing that as, companies that can recapture inflation.
Yes.
Companies that have contracted pass-throughs. So now we've got a list of those companies where, their income streams are not sort of threatened by competition. They might be contracted for 15 years or triple net leases. There's a whole bunch of securities that sit in this, what I'd call real assets, real income category, these asset plays and bond-like equity companies. So there are a multitude of sources of value that we've standardized in the way we approach, analysing those companies. And by putting them together, you get, these diverse portfolios that become very robust. And I just want to emphasise, when we analyse ourselves, and we've analysed ourselves to death over nearly 20 years now, roughly 1 in 3 things we do are actually wrong, destroy value relative to a benchmark. And so the trick in that standard, obviously you want to reduce that, but it's really difficult, Tim. I can tell you there's so much going on in the world that we just get stuff wrong. The trick really is to identify mistakes and rectify them. So coming back to this culture of humility, which informs the investment philosophy, and it also informs the way we run our business. So, it applies to all stakeholders, clients, employees, and companies that we like to invest in. And the culture of humility, I want to emphasize, is not a biblical concept of meek and mildness. It's quite a fierce concept, humility.
Yes.
People, I think, really misinterpret humility as being meek and mild and deferent. It's definitely respectful, our definition of it, but it's really honesty with self, let alone other people. And that honesty of self comes out of self-awareness and, self-agency and admitting one's, mistakes and being open to information. And what makes this really tricky in the investment world is this paradox between flexibility and discipline. And so, you'll read in our literature, the kind of the creative, flexible mind is incredibly important because the world is constantly changing.
Yes.
But so is discipline. But the question that we don't really answer that well in the literature. Well, how do you know the difference between when to sell, when to hang on?
Well, the old adage is it's easy to buy, it's hard to sell.
Yeah.
And I was actually, it leads to the question, how do you know when to cut one loose?
Yeah.
I suppose we've all been in the situation where you've got one wrong, but when do you let go?
Well, I think that's where the humility, intellectual humility is just so important because, one has to get their mind, in a complex world of what's actually a secular change versus a short-term change. What's the investment proposition? So, for us, it all starts with the investment proposition around, what's the value here? And so you kind of replay, and our investment process, if you like, just all built about repetition. So we keep on going back and seeing companies time and time again, a couple of times a year. We love to do the in-person thing. And it's all about, really, yes, we do all this analytical work, but it's kind of watching the behaviours and the responses and comparing and contrasting.
I read you do something like 1,500 visits a year.
Indeed. That's across
a phenomenal amount.
All portfolio managers, 20 people in the investment department. So it's a huge amount. We concentrate those visits down to roughly 400 companies across the world that we've formally put on watch lists in terms of companies that we want to build relationships. And, out of those 400 companies, we're doing these 1,500 company visits a year, but a lot of it is repetition, like going back and talking to them, what's different, what's permanent damage, what's just a short-term blip. I think that what we're looking for in the risk adjustment process and our decision-making is very much driven around these risk factors. So in that VOF, there's value, which is a quantitative process, the qualitative process is driven off these 1,500 company visits and contacts, and it was not so much one-on-ones in the last 2 years, but certainly had the Zoom equivalents.
Yes.
That qualitative assessment of the value, and for your listeners, I think about values, it's really just 3 lines, even though we've got these 1,000-line models. It's just sales, margins and returns. And that's it, in terms of what drives the, cash flows in a business. The qualitative work we're doing is really looking at is that skew left or skew right? Is it sustainable or sort of a 5-year pathway or a 1-year pathway?
Yes.
So that qualitative, we're thinking about, numbers in terms of outcomes and how they, the current stock price is inferring in terms of values, the stock price reflecting all of that sort of growth that we see, or is it not reflecting it at all, or somewhere in between? Just to give you a sort of practical example, in the US, margins are at world record highs. When I started in business, margins in the US were around that 5% level as net profit to sales margins.
Yes.
Today they're 12.5%, never been higher. Now, the composition of the economy is very different, so there's a lot of nuances and doing comparisons with yesteryear. But, that's to be watched, because world record margins, rising inflation, interest rates, what does that mean going forward? So that qualitative assessment, we do business by business and then do compare and contrast. So ultimately, we just want the best, the best risk-adjusted returns. So we sell a good stock for a better stock.
Yes.
So that's a sort of a brief summary. I guess the culture of the organisation, is really built around, this idea of humans have a propensity of what we call a hubris to humility cycle, and stock markets do as well, industries do, football sides do. And you see this pattern in all sorts of, human organisations. And, what we're looking for, one of those risk attributes is what we call focus managed behaviour. Yes, we want focus, but it's behaviour, the word that I'd really zero in on.
Yes.
Are they focused on the key drivers of value? A lot of these companies out there, they're pulling all, profits going up, but they're pulling levers less than conservative way, putting up prices, channel stuffing, leveraging, doing unnecessary buybacks in terms of leveraging the company up just to get EPS. And there's a very famous, I was in Washington on the day that Fannie Mae sort of put the white flag up. Fannie Mae's the mortgage journal. So I actually had a visit with the CFO. I went to their offices and they said, "Oh, he can't see you. He's busy." But those guys, semi-extension of government, paying themselves $50 million bonuses, but there was leveraged, if you included all the option contracts, like 150 to 1. And
Goodness.
So you can really move the dial just through leverage. So, we do a lot of work to sort of look through, those sort of shorter term thinkers. That's what we like to invest in, is companies coming off the bottom, conservative opportunity sets, balance sheets that are latent with the ability to buy back cheap stock if they can. One of the sectors that we love, we call them capital allocated champions. They're like listed proprietorial or private equity firms with one big difference. They're very lowly leveraged and they have deep vertical industry knowledge. And so in these downturns, they're just fantastic. They just hoover up all the competitors who fall by the wayside. So they're the sort of companies that we're looking for, these proprietorial people that get to eat their own cooking, but because they're owners,
Yes.
not agents.
No.
So I think that sort of hubris to humility thing's been very strong in our investment culture. It's come out of, going way back to my state super days. I was reminded of, the QV building here, QVC.
Yes.
State Super New South Wales was the developer of that. And there's the geniuses back then, the public sector, there's a couple of put options and that was one of them. And so right at the bottom right in the crisis, State Super Board's getting put these massive empty buildings.
Oh my God.
And, the hubris that I saw in the property market in the late 1980s was just incredible. And so seeing those sort of cycles when money, and this is what's very interesting about the current conditions, when money is short or liquidity is not available, there's just no bottom, there's kind of no buyers. And if you have forced sellers, there's just incredible opportunities that come about. Now, the world of free money and, MMT, the magic pudding of MMT, modern money theory, and, New York bestsellers everywhere a couple of years ago about, government debt doesn't matter and printing money is a good thing and all of this. I get the crisis need and all of that, but that's really under a lot of pressure now. And so bringing some normalcy back to risk, and with obligations, there's the responsibility of paying things back, and all of that sort of idea, I feel, will come back into play. And I put that into the context of this hubris to humility cycle that we see.
Gosh, well, when you look at it in that light, there's plenty we could go on with there in terms of the current market. I will come to that. When you look at where you've invested, Peter, both Australia or locally and globally, have you found it more difficult to invest globally than locally because of location? I know in this world we've got technology coming out our ears, we've got availability and information is everywhere, but is it still made a difference?
Well, our journey on this question, when we headed off 15 years ago, people would rightly say, by the way, well, you've never invested overseas, even though we've been tracking Australian companies and visiting competitors overseas very aggressively for all of my career. So it's not 100% true that we don't have international experience. But in terms of, running portfolios, it was true 15 years ago. And my response to that was, I don't know, come back in 10 years' time and I'll let you know how it goes. So I think there's a couple of takeouts. There's no question it's different. We've got our offices are in Collins Street, Melbourne. We've positioned ourselves between 120 Collins and 101 Collins. When all the managers come down from Sydney and Brisbane and Perth, we just, seeing the big brokers, we just hook them in and have a bit of a chat to them and stuff. So it's very local, and we get on planes and fly around Australia. So that logistical advantage, if you like, of being local is clearly different than getting on a plane and going to New York or going to the US. So we've had to adapt that model, and so what we've done is reduce the number of companies that we track internationally. Even though we're global, we're tracking a relatively small watch list of companies in North America, Europe and Asia to accommodate the logistical point, in addition to the technology. I'm talking about this is one-on-one visits, right?
Yes.
Secondly, we've really championed the idea with great success that we actually want to go and see companies in their offices. So, in the last month, for example, we've come out of the gates very hard. We've been to India, North America, Canada, Europe, UK, going to Japan in 2 weeks' time, 3 weeks' time. It was not me, but other team members. I've actually been in the US for a couple of months over the last 6 months. So we're just very wide for international travel. We've done that by building focused teams around these clusters, and many comments as we're the first person, in the UK and Europe and US that they've seen from overseas. And so we love hearing that feedback. The networks the guys have built are just incredible and really have surprised us in terms of our access into these incredible companies. They're not in the mega, they're not the Googles and Microsofts, but we're talking, $10 to $50 billion type companies. And so I would say international is definitely harder. The learnings have been great. We've dealt with that through what I'd call network building. This is my favourite story. Alan Goldstein invested in this company 12 years ago called Danaher.
Right.
It was a mid-cap then. It's, about 150 billion market cap now. But we've made money 5 ways out of Danaher. Firstly, the stock's been an incredible success story. Secondly, they've exported a couple of founders called the Rail Brothers, set this incredible manufacturing, high-quality manufacturing culture and business and global company now. And so they've exported CEOs everywhere, so people left Danaher to go to another Fortune 500 company. Some of those instances we've followed those managers, and the playbook is exactly the same. You turn up, how you going, Joe? And we've heard this one before, and because we're so confident in that culture and approach, it just gives us a pattern, if you like, to assess. Secondly, they're very strong at shedding divisions. When they get to, a size, they spin them off. And some of these have been very good opportunities for us because, once again, we know the culture. They've just put a little bit more focus around it. Thirdly, they've been very generous at answering one of our favourite questions is, got any good competitors in this product or division? So they've kind of led us to a couple of smaller opportunities. And then after about 5 or 6 years, Chris Dixon, who runs the European side of our global fund, said, have we got any equivalents in Europe? And so that question kind of led us to some incredible, not exactly the same as Helmer, but similar culture and similar approaches, if you like, to this capital allocation question. So that circle, if you like, of opportunity that's come, and the one piece of advice we give to ourselves, every time we go small, restrict the circle of interest around these quality companies internationally, the better we go.
Yes.
So, we've kind of, and I think we're still on that journey. We still haven't quite of, exploited fully the opportunity of keeping ourselves focused. The other thing to say about international investing, I do think is true, is, it's just more complicated. There's more countries, there's more regulators, there's more, industry competition that you may not see as easily as you do in Australia. But one thing in terms of our, investment philosophy, it's transcended and been able to be transferred into other topics and jurisdictions. I think the philosophy is incredibly interesting because I even like to say you can actually apply this philosophy to fund managers. Some of the things I talk about, this hubris, you see this in fund managers. I like to say whenever, we've been through, significant, I speak personally over my investing career, there's been a couple of occasions, gone through some really bad underperformance, which are related to the investment philosophy, but only a couple, that the kind of underperformance, when you kind of err and forget and, it's, we're not perfect. We do have our, good quarters and bad quarters,
yes,
type of thing. So, and that gets back to this culture and mindset, being present and being, really focused, applying, the metrics we like to apply to others, turn those on ourselves around, focused behaviour is incredibly important. And so, taking that philosophy and applying it into the international markets has been a joy. And I feel, we're 15, 16 years into it and we're kind of better networked and better, resourced and sort of much more clearer around where we see those value opportunities than we've ever been.
Oh, that's great insight. Thanks for that. I think it's a great way when you look at that to then segue into the markets as such. Now that we've sort of covered off on Cooper Investors and the way it's evolved, and now where you've talked about the global strategies and also then locally and the differences. But when we look now, we're in an interesting situation where we've seen in more recent times markets have started to take a bit of a turn, and you've alluded to that. Rising interest rate environment, rising inflation environment, supply chains being restricted. Can you give us a little bit of an insight? And I think this is where a lot of the listeners would be really just so happy to be able to get some of your insights into what you've seen in the past in terms and how you can relate that to what's happening now. And I say that in light, you've experienced some pretty major crashes.
Violent, I'd say.
Just like 1987, the bond crisis in the mid-90s, the Asian crisis in 97, the tech bust in 2000, the GFC in 08, and then more recently COVID-19 and the downturn we had through there. It's a big question as to what's going to happen next. And I think there's a lot wrestling with the idea of, is there going to be a soft landing or is there going to be an absolute demand destruction because of higher interest rates and high inflation and this supply chain constriction? So, Peter, without having to go into war and peace about it, what do you think might be sort of something that we could hang our hats on as investors?
Tim, I think one of the underpinning tenets of the investment philosophy is observation, not predictions. So, yes. Which is an incredible concept, by the way. It's a quantum physics concept, and what's the difference between observation and prediction is a philosophical discussion we can have some other day. But it's very, very powerful. So, I think the way I think about it is kind of, financial history. And my own history from 1987, the financial history, going back, let's say 120 years since stats were collected on inflation and returns and so forth, is quite interesting to delve into. And in rough terms, don't hold me to the exact numbers here, but inflation rates of 0 to 2 are very good for equity markets. On average, 2 to 4 is actually not a problem, a little bit lower. And I'm talking in terms of real equity returns here.
Yes.
In real terms, after inflation adjustments. And, 2 to 4 is fine, a little bit less than 0 to 2. After 4% inflation, you start to get real degradation of equity returns, and I'm talking over rolling, 3, 5, 10-year periods, but lower. You really notice the drop-off in real returns coming out of equities, and obviously, devastating for bonds. At 7%, and it seems to be a sort of a bit of a threshold number, 7.
Yes.
It's really bad. That's when you go into real negative return territory, and there's only been one decade in 120 years where that's happened. It was the 1970s in real return. So the kind of the numbers are quite small, which makes the analysis a little bit sketchy, if you like. The observations over 5 and 10 year periods I'm looking at. So today, we're above that 7% around the world. In terms of underlying inflation numbers, which is a concept I'm not too keen on. Underlying meaning excluding energy, excluding food. So
Yes.
You don't eat, you can't turn the lights on. I don't know that world, neither do you. So, but like in the attempt to look at what is the underlying rates of inflation, it looks like that's about 6% in the United States and about half that in Europe. And I actually don't know the exact number in Australia, but I think the underlying, if you looked at underlying wages growth, it's in that 3 to 4% category. So if you want to sort of zero in on the underlying, and this is, this is not my opinion, this is just an observation. The promising outlook would be that you kind of get inflation settling down into that, 3, 4, 5% area, which wouldn't be great for equity markets, but it's not a disaster. The concern big time is, well, we're actually above 7, and what if that goes on much longer and you do get the demand destruction? I'm going to pause after my next comment because this macroeconomic stuff is just not something that we sort of spend a lot of time on. Rather come back and talk about what sort of companies can actually get through this and turn adversity into opportunity. The concern, I guess, is, well, how do governments actually fight inflation? Because with the amount of debt around, just looks really tricky. And we've had such a long time, and this is the challenge for people, myself included. The ability for governments to up the ante on, both fiscal and monetary policy has been pretty consistent. And this is the every time, buy the dips mentality has been reinforced. Well, what if there's no levers to pull anymore is kind of the concern. So I think it's going to, it's a challenging time. I think we're very focused in on inflation. There's no debate about inflation. It exists and it's very strong. And so, finding businesses with pass-through contractual, revenue streams, finding businesses that can actually reprice their businesses in live time and really deal with that. And so there's lots of examples of that. And then there's lots of examples of, margin destruction. Interestingly, looking at this comparison, in the US, margins are all-time record highs. In Asia, there's been just, and across the big cap sector, there's been like massive downgrades around operating margins in businesses down 10, 20, 30%. So they've kind of absorbed a lot of the supply chain and then specifically companies, international companies with exposure to China and supply chain sourcing have also had some sort of margin destruction.
Yes.
And one of the reasons in the US is just that high propensity or high change in industry structure around technology. High margin businesses, they're able to, very adaptive businesses as well, those technology platforms. The bigger profitable ones have been incredibly adaptive because they don't have, they're technology companies. They're, zeros and ones. You can manage the inventory much more easily in that sort of business. So I think, in terms of long-term history, Australia's been generating around 6% real returns for 120 years, probably one of the better markets in the world. US a little bit less than that. In my career, each of these, I've had 3 big downturns: the 87, GFC, COVID. Call them the 40% corrections.
Yes.
And at the time, they're really, even for well-positioned fund managers, it's difficult. And I think this idea of durability of portfolios and business is incredibly important, because to actually prosper, and one bit of me is excited by downturns. Like that's when you start to see real value, and we're seeing a few examples.
An opportunity.
Yeah, wouldn't want to rush too hard into it because it's early days. But there's some stocks down a long way. Lots down 50%. I think half of the Nasdaq's down 50%. 20% of the Nasdaq's down 70% by number.
Yes.
The overall Nasdaq's only down, I think, 25% because of those big successful platform companies. So I think the strong get stronger in industry. That's very much about sustainability and durability of balance sheets and managers who know what to do, managers who know what real value is in their industry. So having, management with deep industry expertise. I think drawing upon the idea of diversity is incredibly important because, myself included, is you could say, well, this is a very special time in history that I haven't actually lived before, because since I've started work in 1987, I was a bank analyst at State Superboard New South Wales, and I'll never forget the day I read a white paper, and only if I had been a bit smarter to interpret the second and third derivative of what I'm about to say. The white paper was on risk-weighted assets, a concept dreamt up in Basel, Switzerland, applied to banks around the world. And it basically said, well, we're now going to risk-weight assets, and certain assets will have half the capital. In case of home mortgages, will have half the capital they needed yesterday. That was overnight. And then they took that 50% weighting in the case of Westpac and CBA down to like 12% or something, which just meant that you could leverage the balance sheets by 5 and 6 times more than what you could under the old capital adequacy laws.
Yes.
And it was just profound, Tim, and it relates back to somebody who I haven't really followed very closely, but it had a really big impact upon my thinking in 1987 when I read The Alchemy of Finance by George Soros, and he talks about effectively pyramiding, or the virtuous cycle and the vicious cycle. And so the virtuous cycle of you get some equity, you put it into real estate, the asset price goes up, you've doubled your equity with a 20% change in the asset price, you then go and buy more assets.
Yes.
When you do that across economies, it's a self-sustaining, fulfilling prophecy where, the buyers, they make more money, they invest more, therefore the asset class goes up, therefore everyone's richer, and so on and so forth until the elastic band can't be stretched any further, and then you get the
contraction,
the vicious cycle down. So that concept is a hubris to humility concept. And, we've had so many expansions in the world, the latest one being ETFs, superannuation, the banking sector, as I mentioned, the prevalence of hedge funds and private equity, borrowing cheap money, and there's a lot of excellent ones, by the way, there's lots but not many in proportion to the total industry. It's like any industry, there's some outstanding players in that space, but the idea of leverage and expansion has just been such a big factor in finance. We've invested in quite a lot of the stock exchanges and so forth, like the ability of financial technology to keep on innovating new products, I believe will continue to go on, but it just feels to me as a very significant time in history where there's been so much of it. There's more fun.
Suddenly released.
I mean, my favourite one, there's more fund managers than stocks you can invest in Australia, and you can multiply that by hundreds around the world. How does that exist? So, proliferation and financialisation has been very, very significant. And I think we will go through some, contractions. I think this downturn is actually good. It's bringing risk culture back into people's thinking. There's a lot of businesses out there that I'm not quite sure about and, a bit out of my league here, but the VC industry seems to me very fueled by cheap money and customer. You just have an idea and, I'm all for innovation, raise a stack of money and just go after customer acquisition without any profitability. And you've seen what's happened to Netflix recently, down 70-odd%. And, it's a really interesting model, but there's competition everywhere now. And so profit does matter. And so I think for incumbents in the space that we're investing in, deep domain expertise, really competent, good balance sheets, companies are going to get stronger. So, that's something to be looking forward to. I think the other good news for those who are cashed up, is the absolute, anyone who's been conservative and had, all term deposits and, retirees and stuff, they've just been shafted for the last 10 years.
They're finally going to get a return on their
Finally,
money.
you can get 2 or 3% out of these
Yes.
low risk assets, and maybe it gets up to 4 or 5, and so you'll have a whole section of community, and that one once again around endowment and all the way into equity type stocks. There'll be it's always good to be reminded. If you look at the long term history, dividends have produced roughly 50, depending upon which market you're looking at, but say around 50% of the total return, of the real return, dividends. And capital growth's only been 3% real.
It's enormous.
So it's something to really be mindful of. We would expect there to be some real opportunities in that space.
Peter, I'm mindful of time. That was just such a great insight. I have some rapid fire questions I'd just like to throw past you. We can start with international issues such as the Russian-Ukraine conflict. How do you think that might evolve?
Well, what was like this, relatively small data points impact markets between 50 and sort of 200 days. If you look at, Iraq wars, and this feels a little bit more significant to me. But, it'll, depending upon what happens here and obviously, any escalation beyond what we're seeing and the tragedy, I might say, and, I've got some insight into that tragedy at a personal level. So the knock-on consequences, very evident in terms of reshaping people's activities in the energy sector, defence spending. Germany spends 1.5% of GDP on defence spending. US is close to 4%. Donald Trump pointed that out to people and had some impact, I guess. But it's I think that if there's anything good that comes out of this, will be just the awareness that national sovereignty and security is not a gimme, and should be a message to Australians as well in the long run. So you're seeing lots of responses around national security and defence. And so on the energy side, you're just going to get acceleration in terms of, not in addition to energy transition concepts, in Europe particularly, wanting multiple sources of supply of energy. And certainly, Germany, with their 80% reliance upon Russian gas just seems so anomalous and ridiculous in terms of their strategic planning. So that's going to drive a lot of, even more investment into this energy transition, solar, wind, of course, hydrogen is getting a lot.
Yes.
Terminal investment, to be able to accept, seabound LNG gas, and then revisiting, other there's, I think I read the other day, Germany's even firing up a coal-fired power station. So, there'll be a kind of an extension of some of those sunset supplies in the traditional oil, gas, coal.
Yes.
I believe, you could sort of extend whatever you're assuming in terms of those sunset industries. There'll be kind of quite deep cash flows embedded in those already sunk capital. It's kind of an interesting concept. So in terms of investing, we've taken a bit of a barbell approach, so we're investing in the new transition, some really, and Australia's actually got, and New Zealand particularly, outstanding, wind generation technology and operatorship, and been doing it in New Zealand. They've been doing it, way before the climate change topic. They've been doing it for 50 plus years there. So there's a lot of, really good expertise in Australasia around these alternative energy sources, and then investing in more traditional supplies of energy. I think that's the approach we've taken, and it really sits nicely with multiple sources, and everyone's a winner. Yeah. So, but Ukraine, it's obviously very concerning, and it's also exposed geopolitical alignments. There's a lot of you could see in the UN vote of no confidence against Russia, those who abstained and those who voted for Russia. I think there's only one or two, but they're all conflicted parties, if you like. But the abstainers are very, very interesting. For example, India has, and the reason I think is India's been had a strong relationship with Russia in terms of education and military supply.
Yes.
And India, is a fantastic opportunity for India, for Australians investing in India, and the world in some respects is the largest democracy in the world. But they're in a slightly tricky position. You've got China backing Pakistan with nuclear. You've got to the south Sri Lanka, indebted, bankrupt Sri Lanka. Chinese have been huge investors. I'm pretty sure they own, along with Darwin port of Sri Lanka, so very influential in that jurisdiction. And so I think India, is in a tricky geopolitical stance and not wanting to have enemies on all boundaries. So they've been quite silent, if you like, around the Ukrainian. But there's a lot of galvanised, focus now in Europe. So we'll wait and see.
Thanks for that answer. You touched on it, China. We sort of touched on China in terms of the challenges with China, but where do you see that evolving as well?
it's never good to have a dispute with your biggest customer in business. And
No.
it seems to me that we're in somewhat of political conflict with our biggest export market. The Chinese century and the march towards full recognition has really, really got ahead of steam now politically in China under Xi Jinping, and they're kind of more explicit in exerting their presence around the world, including our neighbourhood and so forth. I think my hope, and it is hope, it's not really an informed decision, my hope is that China leadership have been incredibly successful at navigating banking crises, all sorts of, I guess, developmental issues over the last 30 years. So, the success in building industry and economic wealth has been very, very applaudable. And one would hope that they also see the risks of being alone and isolated. And I think perhaps they've also been pretty clever at not going too hard in their alignment, clear alignment with Russia. So, they also have a lot at stake here, around global demand destruction and contraction, big time.
Yes.
So one would hope there's some sensibility that their role in the world is undeniable in terms of size and population and GDP. They're already the biggest economy on a purchasing parity basis, and will go past US, in the next 10 years on a real economic size basis. Their military is definitely matching US fleet size. If you look at the numbers, and frankly, probably in some areas better because it's later technology. So I think their influence is going to continue. You'd hope that it's bounded with sensibilities, and that economic realities also become evident to the leadership of China.
We've got an upcoming federal election, and I know that the impact of government has a role to play. In brief,
it's a tough two-horse race, Tim, and every time I come back from overseas, I sort of ask myself the question, it's such a, first time in Perth in 3 years, the weather here is outstanding. We're staying in discount half-price Hilton Hotel opposite the Ritz there, looking up the Swan River. It is absolutely magnificent, and I'm not just saying that. It's the quality of life. I come back through
good on you, Peter.
Melbourne Airport, it works, and their friendly customers officer, gives me the pass-through every time. And I do wonder, how come we've kind of managed to get here? Because when you look out the window at these politicians, it really is despair city across the board. So what we do is draw a line down the middle of the page, and I think the influence of state capitalism and governments around the world, including Australia, is been getting bigger for 50 years and continues on, right? And in my view, it's gone way past sensibility in terms of the amount of kind of influence and direction one needs to be in business and getting from government. But we rule a line down the middle of the page and say who's a winner, who's a loser, and who does the government actually need? Because the hubris, the humility cycle applies to government thinking and politicians. And so when they go too hard in certain areas, you'll see their behaviours and their minders and PR machines back off around regulation and interference. And so, I think around infrastructure and delivery, around services in healthcare, I'm sure they won't mind me saying this, but the biggest government arbitrage would have to be Macquarie Bank. It doesn't matter which government; they just seem to be able to, come up with business models that, we love Macquarie. They're a great company, but companies that are adaptable and have things that governments need and want. And I think relationships is very important. So with customers and government is very, very key. And, companies that can navigate that landscape. So companies like BHP are, the world's large here in Melbourne, they're, just an incredible company around all sorts of issues, not just, digging dirt out of the ground, but, around community and efficiency, around the new economy. BHP is very exposed to materials that need to go into all these new EVs and new technologies and so forth. So, there are those sort of companies. Lend-Lease, just to mention one company, one of the most advanced companies in the world around demography and efficient, affordable housing. They run 40,000, people wouldn't know this mostly, that they run 40,000 homes for the US military. Lend-Lease, urban renewal, that the intelligence inside that company is incredible. They struggle a little bit about the monetisation of that IP, but they're a sort of company that governments will definitely need to recalibrate these social agendas on either party. Transition technologies. I'll give you another one-liner. You start closing down Origin and AGL, biggest sort of coal pumpers in this country. You start closing those coal-fired power stations. What's going to happen? Well, energy price is going to go up, right? So that's a win. You close them and the energy prices go up. What if governments say, well, what if we turn all this energy off too quickly? Reliability and sustainability of industry, and they decide, well, we just need to transition this a little bit longer. You push those out in time. Well, they've got sunk assets with longer income streams, so it's a bit of a win-win backdrop in my mind around those sort of government risk areas.
Yes.
We've got investments in affordable housing that they tend to be retirement orientated, and depends upon the model. But there's some lifestyle communities. I mean, the government should just tell them to go and sort out the affordable housing problem. They build houses, and I've been through them in Melbourne. 150 grand costs, and they're manufactured homes, right?
Yes.
But they're fantastic. I'd easily live in one, cheap and affordable, and then better still, they build communities around that concept. So there's some really good innovation that can solve all these
issues,
global problems. And
yes.
as an investor, I think. A lot of people talk about ESG and responsibility. I mean, it's really about, business innovation and coming up with ideas to solve problems. That's where the opportunity is. And so there's lots of problems in the world, but, there's lots of opportunities to solve those problems.
Australian dollar.
Well, it should be going up. It's going down. It's going to make us, I think, under 70 cents today, Tim. It's going to make it super competitive, great for tourism, great for exporters, a bit expensive to take that European holiday. So I think it's a little bit dependent upon the bit of catch-up from our central bank. We're sort of tracking a little bit behind the US curve here. So that's why it's been weak. But it looks pretty good value under 70 cents to me.
Oil?
Stronger for longer would be my short answer for the reasons I said before.
Yeah, sure.
I think there's a diversity, risk diversity that's going to hold that energy source in place longer than we were expecting.
Gold?
I used to say you can't eat it, doesn't pay dividends, not interested. But I think we've had we like investing in gold royalty companies. They just take the dividend and don't have to worry about the mines and all the hard work that goes into actually digging it out of ground. There's one called Franco-Nevada that we've got a bit of exposure to in the global funds. But I'm surprised it's not higher, actually. And that was explained a little bit by the $3 trillion that rolled into cryptocurrency in the last couple of years.
Yes.
But, gold hasn't sort of gone up as crypto's gone down, which I found a little bit surprising. So I think there's a place for it. So unquestionably there's a place for it. Like, a store of long-term wealth. But, our sort of thinking would rather be in more productive, diversified sources. A port that exports agriculture would be our equivalent of a kind of a gold stock, if you like.
Okay, yes.
But I think that concept of reserve currency and fiat money, Maurice O'Shaughnessy, the guy I referred to, and friends written, unpublished yet, a book, a 1,000-page book on the history of money. And his lines, to me, is there's no example in history where fiat money of this disproportion that we've seen has survived and not ended in a gold boom. So, I think there's a place for it.
The new economy, B2B, B2C, data, AI.
Oh, massive.
Massive?
Massive fan. And we're at the conservative end. So, I watch Cathy Wood, Arc Capital. We're not in that. So, you're interested in that sort of frontier innovation. That's not where we're invested. But in terms of transformation, I was in Tulum, having a honeymoon in Tulum, Mexico recently, which is a bit of a wild place.
Yeah.
But Bali of South America, you could describe it as. But it's, the prices there are just off the dial expensive. And it's because of all these tech natives from around the world and their $500,000 million a year jobs, punching out code from Tulum, Mexico. And so, I think, and one of the interesting things about the COVID downturn, no one wants to come back to work doing 3-4 day week jobs. The public sector hasn't been at work for 2 years and no one's noticed. So if you can work from home, you can work from the Philippines or from India or, Ukraine.
You have a choice.
Until recently.
Yes.
So, I think the proliferation of services and IT and data and new business models, we've been through this incredible, somewhat of a bubble, I guess. But I just see it as a kind of an investment in new innovation and I think that's going to be ongoing.
The last couple, you alluded to it earlier, but Bitcoin?
I think the underlying technology is where the real story is. The problem I've always had with Bitcoin, like I'm a classical liberal at heart, and so the idea of independent sort of currency natives and store of wealth outside the money system, I'm philosophically well disposed of. The problem is you're really up against the biggest monopoly of all, and that is government. And so government is not going to let crypto flourish outside the system.
Yes.
And so therefore the value, well, you're just back to just another form of paper currency. If it's regulated and becomes, and the central banks start issuing their own cryptocurrencies, which there's talk of. So I think it's a bit challenged. The underlying technology side of things is probably where it's all going to sort of go, and new payment systems, which have also been challenged by regulation. But no, I'm not going to be putting money into cryptocurrencies. The amount of conversations I've had with my children and their friends, I felt like a dinosaur 7 years ago, and I still do. But they're getting a bit of a lesson now.
Yeah. Decarbonisation is a very, very well-used word at the moment.
Yep, I think that continues on with government mandates and policy. I think the areas of opportunity in that space is really around the technology side of things and finding new energy sources. The one for Australia is nuclear. It's a bit depending upon your views around the long tail risk. That's just a sitter, because that's a very efficient way, and the technology, my understanding, is really quite advanced, and the number of fatalities in that space are kind of less than the people falling off windmill towers.
Yes.
So it's pretty low in an absolute number sense, and the technology is even better today. Modularised, safer, more efficient. So you're definitely seeing signs of that re-emerging. Hydrogen, a lot of talk about. I don't really have a strong view on that, but and then sort of old, the driving of efficiency. Simpler lifestyles. I see a lot of companies are really driving into reducing the size of their chocolate bars, changing packaging, to be more environmentally
really conscious
sensitive.
Of
it. But there's both a community aspect to that. There's an efficiency and a cost benefit from that as well. So there's quite a lot of benefit in moving towards that more environmentally attractive lifestyle and products.
And finally, active versus passive investing. Clearly, there's been a debate about this, and it's ongoing.
Yeah, I mean, the case for passive is pretty strong. The number of outperforming fund managers, when you do the data analytics properly after fees, is call it 30%. Academically peer-reviewed studies internationally. So I don't have any pushback or argument for that. So other than to say you've got to pick your friendly fund manager very carefully, and thankfully we've fallen into the 30% across all our funds. I guess a little, under the hubris to humility, when I tell a little story about, the ice village up in Switzerland, where the guy, no one, little store owner next to the frozen lake, he couldn't get anyone to rent his skis and gloves to go out on this beautiful lake, because everyone was fearful of the ice cracking and falling into the frozen lake waters. And so this fellow, his cousin, was actually the mayor, and he said, look, I've got to get this business going. We need some leadership. Will you come down on the weekend and go skiing and just show all the villagers that's totally safe? And so he goes out there, does a few figure eights with his cousin, the mayor, and a couple of the villagers saw the mayor out there and took great confidence from that leadership role. And so one by one, the villagers all came onto the village lake, and you know what happens, right? The last villager gets on there, and it's just too much weight, and the ice cracked. So I think passive investing and the innovation around ETFs, which I think there's a lot to like about some of those fundamental ETFs, but the level of, I guess, granularity around a lot of those ETFs, has taken it off into a kind of a casino feel to me, beyond their original idea of asset allocators using indexes to sort of construct, professional portfolios.
Yes.
So there is a weight of money in that space, and I think this downturn, it might get tested. Or what happens when you get unwind and redemptions from those? Now, in the GFC and even in COVID, there was the test, and those ETFs, in not all of them, but in the main, they they kind of held up. So, there's maybe some confidence that they withstood that. But I would be watchful as to, particularly in that retail market, these products are very proliferated, just how committed people are to those products because they're quite illiquid, some of them. So I think that the role of, real investing has never looked better. The ability to get away from indexes or out of the road of, problematical, sectors and so forth for active investors. But, that's going to come down to skill and dexterity and so forth. So, I think we're in for a, exciting time with lots of opportunities, but not without risk.
Just fantastic, Peter. Absolutely. Look, I just wanted to ask you a couple of quick questions outside of business. You're Melbourne-based. What's your football team?
Oh, thanks for that question. My football side has not won a grand final at the MCG for 58 years. So it's the Demons, right?
Yes.
We won here in Perth last year, but I wasn't there, so it doesn't count. We're going for one more at the G this year.
Well, you're looking good this year. You sure are.
Yeah, look, it's a long way home, but we like to keep a lid on these things, Tim.
Well, look, congratulations on last year. Anyway, I think you deserved it. You've got 3 beautiful kids, Dylan, Bronte, and Paris. You've managed to work the work-life balance well.
I would say early years wasn't so good.
Right.
Yeah, I've got a great relationship with my kids now. 10 years ago was not so good. So we've, one of the lessons, I guess, in life is, the work-life balance thing or family thing is really important. I was, frankly, a bit unbalanced in the early formative years. Have some regret about that, but I'm playing, doing what I can, Tim, in terms of playing catch-up footy on that. And that's been very successful, actually. Thanks to my new partner, Sapana Basine. She's been pivotal in sort of bringing the family together and, really rebuilding and nourishing relationships with children.
Oh, that's fantastic, Peter. The role of meditation in your life has also been pretty strong. For the listeners, just enhance on the benefits of meditation for you. And I ask that in the context of when you're running such a large amount of money and the performance is such a big thing that you need to sort of daily, you're mark to mark every month or every day in essence. How do you deal with it?
Tim, in the mid 1990s, during my children's formative years, I was a bit of a maniac around, I guess, attention to performance and companies and so forth. And one would describe me as a bit of a stress head.
Yes. And
there's another podcast in the psychological insecurities and fears and so forth that drive and motivate people, and I was definitely in that category. And there's a little church opposite 101 Collins Street. Underneath it, there's a little dark room called the Menagerie, and it's like a little meditation room. And I'd wander across there at lunchtime, just completely stressed out and in conflict with some colleagues and politics and stocks that are going down and so forth. And in
need of a breather.
I'd go. It's like a little sentry, and there's a little candle in the middle with some running fountain water, and I wasn't in the fetal position, but not far from it, just to get some respite from the stress, effectively. Yes. I had to stop going to that little menagerie because you couldn't really see there's chairs, there's other people in there, but one day I started to see colleagues walk in there, and I was so embarrassed. I think A, seeing them, and B, them seeing me, so I had to stop going there. But on a serious note, meditation and just what I'd call, Vedic and yogic philosophy, which is much more than just meditation, has been just profound for me around this idea of presence and focus and being able to, and this bleeds very much into the investment philosophy I was talking about before, you really be able to control or focus in on things that you can control, letting go of things that you just can't change, and having the wisdom to know what the difference is between those two concepts. It's a complete mental game. So in simple terms, meditation is really mind health, mind management, and, bringing a level of, self-awareness, which is a really interesting journey to go on, because just when you arrive at enlightenment, you sort of get another uppercut from life, and, you learn, there's all sorts of drivers behind one's own thought patterns, and it's been such a helpful thing for me in investing, but more importantly, life. It's just brought an ability to rank order what's important.
Yes.
what should one focus? You get out of bed. What actually do you focus on? Is a really good question of fund managers, because we've all got lots of pretty sophisticated statements about that. But it's such a complicated, over-proliferated information everywhere. How do you work out how to start the day and finish the day and so forth? So meditation's been absolutely profound for me, and I'm a great promoter of it. Not for everyone. There's other way. You can meditate in all sorts of different ways. But I'm often, in the sports analogy, give you two quick ones. Third quarter of the grand final, the ability of Melbourne to reset is a word that Simon Goodwin uses.
Yes,
is all about the meditative mindset and actually taking stock, actually focusing in on what works. My other all-time favourite is Roger Federer in tennis. For those tennis lovers, it's a profound, and those top three legends all have the same attribute. On kind of break points in Grand Slams, his statistics around serving goes up. It is phenomenal how they can pull out those absolute elites. The right point at the right time demarcates them from the rest, not their averages. Because if you just look at their averages, there's lots of really amazing players. So and before the serves, those big serves, Federer, I've heard him talking about this, goes into this kind of relaxation mode, just kind of this concept of letting go
and resets
and surrendering, not giving up. Don't confuse the word surrender, but just actually acceptance of the adversity or the challenge one is facing, and embracing the ability to lean into what's worked. This is what we spend a lot of time analysing, what actually has worked in our history, what hasn't worked. Stop doing that and do more of what works. It's that simple, Tim. But the mind is just 80 billion neurons of distraction and emotion. And so actually getting on top of that and self-understanding is absolutely critical to any sort of mastery in my observation experience.
Gosh, just a fantastic insight. And I must say, Peter, we've sort of run out of a bit of time, but we could talk for a long time about all the other parts that I've got a list of questions a mile long. But I must say, it's been an absolutely wonderful chat. And I just want to also say thanks a lot for taking the time out. You've just been very generous with your views and your insights, and we now understand a lot more about you as a person, but how you've got to where you've got is quite phenomenal. And the success has been extraordinary. And you've given a really good insight into not only your business, but you, which is really, really quite powerful for us as listeners to this story. So I just wanted to say thanks very much for joining us again, and we really appreciate it. And I do look forward to another podcast with you at some point where we can expand a bit more on some of the other areas, because there's a lot to go through. But Peter, on behalf of us all at Euroz Hartleys, and thanks very much for your time.
Well, thank you for inviting me in, Tim. It's absolute pleasure. Love coming to Perth, the innovation and get up and go centre of Australia. Yeah, happy to come back.
Thanks a lot, Peter.
Thanks, Tim.
It's been a great time. Thank you.
Bye now.
Thanks for listening to this episode of Finding the Front, brought to you by the proudly West Australian wealth management and diversified financial services company, Euroz Hartleys. If you like what you heard, please don't hesitate to tell your friends and subscribe to the podcast through your podcast host of choice. If you have any questions or would like to contact us, please email our fabulous producer Bridget on communications@eurozhartleys.com or visit our website at www.eurozhartleys.com. This podcast has been general information only. Euroz Hartleys holds Australian Financial Services Licence 230052.